What we do at RadioActive Trading is we talk about a unique methodology using put options as insurance for our long stock investments. And the reason, of course, why we do this is because it solves really the main problems that we face as investors. And of course, what we want to cover today is what is the main problem that we face as investors? Why have we not solved that problem yet? Our suggested solution to solve this problem, and what is possible with the technique going forward. So first we want to identify what is the main problem we face as investors. Well, we just don't know the future. If we knew the future, it would already be priced in. You saw some interesting techniques just recently looking at some of the Fibonacci numbers from MTI and things of that nature, but a lot of times different things can happen in the market that just go against what our expectations are. In any investment strategy, whether you're just trading long stocks, whether you're trading covered call strategies, whether you're buying options or trading Forex, you're going to have strings of winners and losers in any strategy. It's possible the way the market dynamic changes, what we see today is not what we saw 4 months ago. But selection criteria that worked for you 6 months ago are likely not going to have the same results 6 months from now. When we suffer losses in the market, those losses are sharp and quick. And of course, we're using stop orders. We'll get closed out very quickly and before we can take any other action. Naturally, we know our gains are more gradual when we're looking for upticks in the stock and upticks in the market as well. Now, this problem that faces us as investors does end up compounding other problems. The fact is, we know that math doesn't behave as we expect to. If I have a 10% loss on a position, a 10% gain is not going to counter that. If we invested $10,000 into a position, took our 10% loss, we're left with $9,000. Now, of course, we take a 10% gain, we're back to $9,900. We're still short of our original base. This is a slippery slope that many of you are familiar with, referred to as gambler's ruin or the martingale. If we take a 25% loss, we're going to need a 33% gain to get back to break even. And of course, if we suffer a 50% loss, we're going to need a 100% gain on what we have left to get back to break even. But if we control our risks to a manageable level, guaranteed that we can only lose 5% on a given position, even if we do suffer a 5% loss, we only need a 5.3% gain to get back to break even. And of course, if I have a 7 or 8% stop order placed on my stock, is a 25% decline from a bad earnings announcement in the pre or after market hours going to get me out at 7%? No, I'm going to get stopped out and suffer that full 25% decline. In the market, we hear a lot of the gurus talk about cutting your losers short and allowing your winners to run. Now, this is great in theory, but do we always practice this, especially when we don't know the future ahead of us? And is there a better way where we can force ourselves into a position that guarantees that we can cut those losers short and allow our winners to run? Now, why haven't we really solved the problem yet? Well, we've been looking in the wrong place. As stock investors, you may get interested and introduced to options, hearing about how you can generate 3 to 6% per month, how you can generate consistent returns, or how you can use leveraged spread trades. But do these most common strategies, such as covered calls and credit spreads, for example, allow us to cut our losers short and let our winners run? No, in fact, a lot of times they do the opposite. Covered call selling is probably the most popular option strategy to generate income. If you first apply to trade options, you're likely going to be given level 1 clearance. They're going to allow you to do covered calls. It has the same risk-reward profile as a cash-secured naked put. In fact, they're parity trades of one another. But as we can see from this risk-reward profile, the covered call strategy caps our potential gains, and it takes on a risk similar to owning the stock. If the stock falls in price, we're still on the hook for maybe 97, 98% of what we invested in. This is sort of the opposite profit and loss chart that we want to see. Now, when we're looking to trade a covered call, the average time value right now, the average potential return if assigned we'd expect from an at-the-money, slightly in the money, slightly out-of-the-money covered call would be about 3% for a 30-day trade. Downside protection, meaning how much you collecting against your stock, would be about 3% as well. And if you enter a covered call strategy, you may use a stop loss of about 8%. Now, you may be a good stock picker. and you may be told that you can expect a 70% win ratio or more with covered calls as long as the stock moves up. We get assigned, we deliver our stock, and we earn that 3% return. But let's take these numbers and a starting capital of $10,000, and we're going to put it into what we call the Trade Simulator tool. And the Trade Simulator tool is going to run a scenario here. Over on the right, we can see some of the values here, where our first trade was a win, so we gained our 3%, we're up to $10,300. Second trade, we had a win as well, we're up another 3%. If we take that track record, making 3% when we're right, losing 8% when we're wrong, and we're right 70% of the time, at one point, you may have a successful trading record. It's a high value, about a 37% gain. That might be what you'd expect, earning 3% a month. However, long term, this strategy by itself, even being right 70% of the time, you come out behind where we started from. We started with $10,000. The simulation shows us we'd be down to about $8,900. So we've got an 11% loss, even being right 70% of the time. Okay, so we got to be right more often. What are some of the strategies we might look at where we can use more of our capital in a leveraged format and get better probabilities? Well, the common answer to that is doing the spread trades, bear call credit spreads and bull put credit spreads. Now, in the case of a bear call credit spread here, if we're bearish on a stock, we might sell a slightly out of the money call. If we're looking at a stock at 50, we might sell a 52.5 call, and then we might buy a 55 strike call. So we know our risk is defined. The risk is the difference in the strike prices. If the stock goes up above 55, we hit our maximum risk. If the stock stays below 50 or 52.5, well, then we make our maximum return. So we do have a dialed-in loss, but the winners don't run. And many of you who've traded spreads before know that when you're looking for the position that has that better probability of 80 or 85%, you're looking to make maybe 50 cents or so on a 5-point spread, or maybe $1 on a 10-point spread. So you end up with a 5-to-1 or 10-to-1 risk-reward ratio. Now, how would this play out over time? Well, let's take that leverage return. Assume a 50-cent net credit on a 5-point spread. Your true risk would be $4.50. So let's call that a return of 11.1%. The maximum drawdown. You might not allow yourself to take the full $4.50 risk. You'd probably stop it when it maybe gets to $2 or $2.25, maybe halfway between the strikes before you look to adjust it or close the position. So if we assume an 11% gain and a potential drawdown of 50% loss, but we're right 80% of the time, one scenario that might play out is we have 83 wins out of our 100 trades. At one point, we've more than doubled our money, and we think we have a really good trading strategy. But long term, even being right 83% of the time, with the strings of winners and losers, we could take that $10,000 and lower it down to perhaps $475, because those losses are going to outpace the potential gains, especially when we're looking at that 10-to-1 or 9-to-1 risk-reward ratio if we took in 50 cents against a 5-point spread. So the covered calls and spread trades really solve the solution of not knowing the future. Not at all. Now, what I just showed were screenshots of what's called the Trade Simulator tool. Later on, you can test this out for yourself and take a look at your win-loss record with your percent gains and your percent losses. Just go to RadioActiveTrading.com, click on the Resources tab up at the top of the screen, and you'll be able to plug in your numbers and see how you might perform long-term by setting the different values. Now, what is the solution? Our solution is the married put or protective put strategy. The profit and loss chart of a protective put position solves our problem. We're guaranteed to have a very limited risk on our position, and we start off with an unlimited upside profit potential. The name of the site, David, was RadioActiveTrading.com. Let me just send that to you by the chat real quick. And we'll send this later on as well. So the website there, I'm sorry, go to RadioActiveTrading.com, and under the Resources tab, you'll find that Trade Simulator tool. Okay, so here's what we're looking at. We're looking at the basic protective put strategy, where we have ourselves forced into a position where we've cut our losers short, and we have allowed our winners to run. Many of you are probably familiar with this. You've seen this at some of maybe the free education at your broker or online, for example, maybe at CBOE or the OIC. It's commonly taught as buying stock and buying an out-of-the-money near-term put option for protection. So again, we're taking our $50 stock, and today I might look to buy a November put option that's at the 45 strike, and I might only pay 80 cents or a dollar for that put. So I have a low cost in, and I have a protection in case the stock falls, and I've left my upside open. But those of us that are options traders, and I know many of you are, we know that the value of option trading is putting time value in our favor. Buying an out-of-the-money put that expires in 30 days, even though it has a low cost, does not put time value in our favor. We advocate a better approach. As investors, we all have the same goals. We want to make profits consistently. We want to limit the losses and reduce our risk so the losses don't outpace our gains. And we saw the problem with that. Even being right 80% of the time in a spread trade position, those losses can counter your gains very quickly. We never want to overtrade or overinvest. And as options investors, we're going to look to manipulate time value in our favor. We want to use that to our advantage in any strategy. But we have to force ourselves into a position where we have that guaranteed limited risk to the downside and the potential for an uncapped upside that we don't see with covered calls. And this brings us to the radioactive trading technique. As Reed mentioned earlier, this technique was developed by Kurt Frankenberg about 11, 12 years ago. Kurt had taken a $3,000 seminar to learn how to trade covered calls and spread trades over a weekend, went into 3 months of trading, and he essentially got burned and gave up his life savings due to having large losses with his covered calls and following his guru's advice. We're going to use that basic setup of the married put, but we're going to do it in a unique way. And we're going to do it in a unique way where the put options are not used only as insurance, but we can also use them as an asset that can be manipulated. Once we open this limited risk position, we can then take advantage of 11 other adjustments, simple things from just selling a call to manipulating the put option to doing spread trades against that initial married put setup to lower the risk and potentially bulletproof the position. And I'll describe what that means in just a moment. Our concepts is we're going to focus on limiting risk first rather than looking for a limited 2, 3, or 4% that we might only have a 40 or 60% chance of getting. We're going to keep our risks in a tight range of 5 to 8%, and we're going to leave the upside open. By entering the protective put position, by forcing ourselves to buy the stock and buy the put, we're avoiding the lie of leverage. Okay? You may see a similar risk-reward profile to the protective put with just a long call, but the risk with the long call is over-trading and over-investing, which we cannot afford to do in our portfolio. And the initial setup and the income methods are going to put time value in our favor. So aside from the general protective put that's taught, what we look to do when we open a radioactive trade is we're going to purchase stock or an ETF in 100, 200, or 500 share blocks. We're looking for bullish stocks, that's true, but we do have ways to apply this in a bearish market as well. When we open the stock or ETF, we're going to purchase a far out in time in the money put option. We're going to look at least 5 months out in time, but we're not going to go more than maybe 15 or 20% in the money. We're not going to buy an out-of-the-money put. We're not going to buy a put that's below the current stock price. We're looking to buy a put that's above the current stock price and in the money. And we're going to look to limit our risks and keep it in that 5 to 8% range. Here's an example of a married put that's in my portfolio right now. It was originally opened on June 12th, 2014. Bought 100 shares of SWKS, Skyworks Solutions at 47.13. At the same time, on June 12th, I bought a November 2014 50 strike put for 580. Now, when we're talking about an in-the-money put option, this 50 strike, this gives me the right to sell to close my shares of stock anytime between now and November expiration at $50. My total cost in the position is $52.93, but even in the worst case scenario, we're guaranteed to get $50 back even if Skyworks drops to $1 per share, so the most I'm risking on my position is $2.93 or 5.5% of the invested capital. Now, does this put option look expensive? Well, it's about 12%, 13% of the underlying stock price, isn't it? Maybe a little bit more. But remember, this is a 50 strike put and the stock's at 47.13. my put is $2.87 in the money. That's guaranteed to come back to me. So the remaining $2.93 is all we're risking. We're just risking the time value on our put position. Now, why would we choose to do that? The common detractions we just talked about, well, I'm adding too much cost to the initial stock price. I paid $5.80 for the put on a $47 stock. Well, we all know the cost of not having insurance. We also showed that that $5.80 is not the risk. The risk is just the time value. And in June, we bought a November put. So we have 5 months of time premium. That $2.93 worth of time value is off of a 5-month period. When you see the purchase of the put option, you may say you're taking away from potential gains because the gains are limited due to the cost of the put. Well, we're going to take a look at that in just a moment as well. And then, of course, the other look is you can't profit until the stock, well, actually is above 52, but when the stock is above the break-even. And that's not really true because time value is in our favor. Here's the basic profit and loss chart of our married put on Skyworks Solution. We have the guaranteed limited risk. We can't lose more than 5.5% even in the worst case scenario. We do have an unlimited upside profit potential. Now when I open this position and I paid $5.80 for the put, am I $5.80 down? Am I $5.80 behind the 8 ball, so to speak? Not at all. The only thing I'm risking when I first open this position is the bid-ask spread of the put option. I could turn around and sold Skyworks the very next minute for maybe $47.12, $47.15, and sold to close my put for $5.60. My loss is really just the bid-ask spread. And that 5.5% maximum loss only occurs if I hold the position all the way to November expiration, I choose to make no adjustments, and the stock's below $50 per share. I'm in control of 2 or 3 of those factors. Number one, I can make adjustments using those 11 different income methods to lower the risk and potentially bulletproof the position. I don't have to hold the position to November. I can exit it at any time if I have my desired profit or if I just want to take a smaller loss on the position. The only thing I can't control is knowing the future. Is the stock going to be above 50 or below 50 or above my break-even at expiration? My plan is not to hold this to expiration. As of this morning, this is where our Skyworks positions stand. The stock's at $53.55. We have a guaranteed profit of $1.30. What does that mean? That means the position is bulletproof. We've made adjustments along the way. We're actually now holding the 55 strike put, and our cost basis in the position is only $53.70 after these adjustments. So with earnings coming up in less than a couple weeks, even if the stock collapses, we're guaranteed to make a profit. And if the stock ramps up, has positive earnings, jumps up to 60 or 65, we have an unlimited upside profit potential. We haven't capped our gains as we would with a covered call position. And so we can still go through earnings and collect dividends, and we can still choose to make more adjustments to increase this bulletproof status. Now, the 3 core principles of radioactive trading, what we look at when we open these trades and when we manage them is, number one, we're going to force ourselves into ideal size trade. We're going to avoid the lie of leverage and the trap of overinvesting. The ATM bell curve applies to any option strategy. If you're trading options and you're not taking advantage of the ATM bell curve, you really have to start paying attention to that. Of course, both the initial married put setup we use in a radioactive trade and the follow-up income methods allow us to manipulate the time value and put it in our favor using the ATM bell curve. And the last concept is what we all know, the red line, the time value decay. All right, so when we have an option, we know it's going to decay over time, but there's a certain curve that we want to look for, and with a certain way we want to set it up to our advantage. Now we know that when we're looking to force an ideal size trade, taking on too large a risk is devastating. We saw that earlier with the slippery slope of gambler's ruin and the martingale. If I allow myself to take a 20% loss, I'm probably going to need a 29% gain to get back to break even. If I take a 50% loss, we know we need a 100% gain to get back to break even. Although we want to limit our risks, taking the risk down to too small of a percentage is a problem as well. A 100% gain on one of your trades is not a big deal if you only invested a small amount, say $50 or $100. And the biggest reason for having just the right size is to impact the expectancy of potential profit. Here's a historical chart of the married put setups we could have seen on Skyworks back on June 12th. The stock had closed a little bit different price. We got in at 47.13 at the close. We see here is at 46.92. Well, with the November 50 put, we had the risk of where we wanted of about 5.9%. Are the out-of-the-money options, the 40 strike out to November, the 42 strike, are they less expensive? Absolutely. But with insurance, you get what you pay for. Now, I paid $5.80 for my put. At the close, it was at $6.20. I could have paid much less by buying this November 40 put for $1.65. But the problem is now I'm taking a 17.6%, let's just call it an 18% risk on the position. If the stock collapsed and I suffered an 18% loss, again, now we're back to needing a 26, 27% gain to get back to break even. And look at the maximum risk here. Even though you paid less, the insurance doesn't kick in until you drop below $40 per share. You've got a risk of $8.57, whereas this position here, we saw that we had the risk with our cost basis of only about $2.50 or so, or that 5.5%. So the in-the-money put option is more expensive up front, but all you're risking is the time premium because you're guaranteed to get the intrinsic value back. And if you go deeper out of the money, you take on a much higher risk, which is not what we want to see. All right, so that is the principle there of forcing an ideal size trade, why we want to buy the stock and buy the put to avoid the leverage and put ourselves in the proper position. The second core principle I mentioned is the ATM bell curve. It shows us how to make money after getting into the married put position, and it sets the first standard for buying time cheaply and selling time dearly, which is what we want to do as an options trader. The strike price of the put option that we buy, along with the income methods that we use later on, are dependent on understanding how to manipulate time value. And it's a really simple concept. The at-the-money bell curve, when you look at any option chain on any stock, the options that are at the money will always have the highest time premium. And the options that are in the money or out of the money, whether you're looking at calls or puts, will have the lowest time premium. So whether I'm buying options speculating on a market movement or I'm buying options for insurance, I want to pay the lower time value. I want to be looking at the in-the-money or the out-of-the-money buy zone. But when I'm selling for premium, for adjustments, I want to be selling premium that's at the money to get the higher time value on the position. You can look at any option chain at any time. Here's just a historical view that we had from a few years ago. Looking at Apple when it was up at about $354, our at-the-money strike in this case would be the $355. And we see here the premium was $10.90 for the call, $10.90 to $11.05 bid ask, but the time value on the bid is $10.90 or 3.1%. As we go deeper in the money on the call side, the premiums increase, but the time value decreases. It's more intrinsic. And as we go out of the money, where it's all time value and all extrinsic, we see that decline as well. And the same thing is true on the put side. When we look at the put premium, we have a time value of about 1061 or 3%. As we go lower, we see lower time premium, and as we go deeper in the money, we see lower time premium as well. And this is for a 1 month out. We're looking at 314. Here's the chain from 4/16/2011. And of course, the same thing. If you go out 7 months or 6 months out in time, the same thing is true. The at the money will have the highest time premium, and then the in the money or out of the money will have a lower time premium as well. So we're looking to buy options in or out of the money to limit the cost of our time value exposure. We want to sell options at the money to maximize time value. And some of the income methods, some of those 11 income methods we use will take advantage of both scenarios. Now the third principle, and the first thing that might come to mind, is why are you looking at put options that are 5 or 6 months out in time? Well, it's because we also want to put this time decay in our favor as well to help us manipulate the time value. The time decay curve for an option is similar, a radioactive element. The initial decay we see is very slow, and it becomes exponentially faster as we approach expiration. The one thing we know as options traders, the one truth that exists, is as we approach expiration of our option, or any option, all the time value goes to zero. The radioactive decay line sets the standard for buying time cheaply as well. Here we're just looking at a basic profit and loss chart of the time value decay curve of an option. You see here when we have the 90 days out to 60 days, we have a much slower decline. And from 120 days to 90 days, you have a much slower decline as well. But as we get down to that 30-day time premium, we see a rapid decay in the remaining time value. This chart does, of course, assume that the stock price and volatility remains the same. But at the same time, if I'm buying options, wouldn't I want to be over here, where I'm not seeing the rapid time decay in that 120, 150, 160-day time frame? And when I'm selling premium to generate income, and I want that time value to work in my favor, I want to be selling in this range as well. So these are three simple core principles that we apply, but it amazes us how often these are ignored in other strategies. Number one, we have to force ourselves into an ideal size trade. We have to properly limit our risk, and we want to leave ourselves open. The profit and loss chart, as I mentioned, may look similar to a long call position, just buying a call, but that's when the leverage starts to hurt you. It's a double-edged sword. It can give you outpaced returns, but it can also wipe out a portfolio very quickly. Buying the stock and buying the put forces us into an ideal profit size position. Taking advantage of the at-the-money bell curve, when we're buying protection, we want to buy in the money to give us that best chance of having that single-digit risk of maybe 5 to 8%, somewhere in that range. And when we're going to apply different adjustments, we're going to sell at the money to give us a better premium. And of course, the radioactive decay line, if I'm buying options just for speculation, just buying calls or buying puts, or I'm buying options for insurance, I want to go further out in time. I'm paying less per day. You know, the option that's 6 months out in time is not 6 times the cost, and also that time value is going to be much slower. So if the stock doesn't match my expectations, doesn't do what I want in the first 30 to 60 days, well, I still have a lot of time value remaining in my option, and I still have 120 to 160 days to go with my insurance in place to properly limit my risk. Now, as I mentioned, once we get into the initial position, we force ourselves to limit our losses and allow winners to run. We're then going to look to apply the 11 different income methods that are discussed in our full work called the Blueprint. Now, the adjustments work, these 11 different income methods. There are some that are used if the stock moves up after we enter the position. Some are used if the stock stagnates when we first get into the position, and others can be used if the stock falls in price after we first entered the position as well. And what we use for every adjustment is what we call the SIGA model. It's our decision-making process for deciding which income method might best be used. And the SIGA model stands for what are our current conditions of the market? What are our expectations going forward now that a movement has happened? What are our personal goals for the position? And that's going to help us determine our actions. And this, of course, is also what allows us to bulletproof that position where we cancel all the risk and still have the unlimited upside. Over here on the left, we see that the initial married put position that we saw before. There's our risk graph here. This line represents the break-even line. So we have break-even right there. And we start off with an original initial risk of only a few percentage points with an unlimited upside. As I enter into the different income methods, we're going to close the gap from our risk level to the break-even point, and eventually, after 1 or 2 adjustments, we may be able to bulletproof the position, meaning now we have absolutely no risk to the downside, and we still have the potential for the unlimited upside profit potential. Now think of what's happened just in the last 5 or 6 days. Those of you that have been trading long stock positions or covered calls, you may have been rolling down your covered calls as the stocks have fallen. We've seen the SPX, we've seen the indexes drop 2%, 3%, and continuing down in some places, some large moves. I have a stock right now that I'm bulletproof on, but since August it's dropped from $70 down to about $48 per share. I'm guaranteed to make 5.6% on that even if it goes to $1 per share. I could close it right now for about a 10% gain, and I still have opportunity to do other adjustments to increase that guaranteed profit or earn extra income as well, even though we've seen about a 28 to 29% drop in that stock in the last month and a half. So thinking about your past trades and what you've seen for yourself, where do you want to potentially be going forward? Controlling your risk. We talked earlier about the covered call position, looking to make a 3% return, maybe using stop orders, at the same time hoping to be right about 70% of the time, and we saw that that doesn't even necessarily make money long term. But if you're trading a covered call position, and you go into earnings, does a stop order help you if there's a sudden gap down in price? Are you going to be able to follow the trade up and still take advantage of that further upside if there's a large gap? Not really. It's going to cost you more to buy to close that call and sell to open at a higher price. So that's part of the problem that faces the common solution of spread trades and covered call investing, and the solution is solved by the one thing that we can control. In a covered call strategy, I can't control how often I'm going to be right. I can look for a position that has a potential 3% return if assigned, but there's no guarantee I'm going to make that unless the stock really goes up in price above those strike prices. The only thing I can control in the market at any time is how much I am willing to risk on any one position. And as we saw before, to avoid the slippery slope of gambler's ruin in the martingale, if you keep your risks into that 5 to 8% range over time, you're going to be able to put that in your favor, where even if you suffer a 4% loss or a 5% loss, you'll only need about a 5% gain to get back to break even, or maybe slightly more to realize a profit. Speaking of which, let's go back to that trade simulator real quick and talk about what is possible. Well, with the radioactive trades, when I limit my risk to single digits, I can maybe take a look at only taking losses guaranteed about 4.5%, 5% or so. No capped gains, so I do have the potential for further upside. And I have a couple positions that are bulletproof that I could liquidate now for about a 10, 12% gain, but let's take half of that. Let's say that when I win, I make 6%, but I've properly limited my losses, so when I lose, I only lose 4.5%, and let's assume a bad track record. Let's assume that I'm only right about 50% of the time. How would that look? Now we see over here with the trade simulator tool, 50 wins out of 100, 50 losses out of 100. Here's my 4.5% loss on the first one. The next win was 6% win, another 4.5% loss, 6% win. But look at this track record. At one point we did almost double our money, or almost tripled our money. Our low value after 100 trades, because we controlled the risk to begin with, was only about a 6.57% drawdown of our $10,000 starting capital. And our ending amount is positive. Out of the 3 scenarios we just showed with the trade simulator tool, this is the only one that had a positive result, and we were only right 50% of the time. When you do control your risk properly, and you keep your risks to a guaranteed level of only that 4, 5, or 6% range, you can actually be wrong more often than right and still make money. We don't know the future, but we know that if we control our risks, we can take losses and still take reasonable profits and control ourselves to where our portfolio goes into a positive value instead of forcing ourselves to manage positions continuously to try to get back to break even as well. Now, I'm not saying we need to be right more often than wrong. That's not what we're looking to do. But in my 11 years of trading, as Reed mentioned earlier, I started off just with covered calls. I abandoned covered calls trading after about 15 to 18 months because I wasn't going anywhere. My portfolio was about even after 18 months of trading and managing positions, and it wasn't showing any profit. I delved into cash-secured naked puts, out-of-the-money naked puts, averaging only about a 1%, 0.8% gain, but still there were positions that took a loss, which would wipe out previous gains. Spread trading can be very profitable, the leveraged spread trades, but it requires a lot of work. But remember what we saw. If I want an 80% probability on a successful spread trade, I'm going to be taking a 10 to 1 or 9 to 1 risk-reward ratio. One loss can wipe out 9 previous gains. This is the only strategy I've seen in my 11 years of trading where I can actually be wrong more often than right. I can have a terrible trading record and I can still make money. And the reason why is because I was able to control the only thing that I can control in the market, and that's the risk I'm willing to take in every position. The benefits of having a bulletproof position where you have no risk to the downside and still unlimited upside, well, they should be obvious. But you have no chance for a loss. If you've got a bulletproof position, you have no chance for loss. You've got a guaranteed return. Where are we now? Well, we've been in a position where the market's been falling, the market's shaky, earnings season is coming up. We can face earnings with little to zero risk on our position. It opens up opportunities for other adjustments we might not have had before, or you can choose to sit back, collect dividends, and have no risk at all. You can withstand market corrections with no need for averaging down. How many of you have maybe averaged down your positions recently as the market's been pulling back and you've been adding more money into your stocks or more money into your options trades to try to average down the position, readjust your spread trade? You're putting more good money after bad money if you took a bullish stance. If you took a bearish stance, hey, you're looking pretty good, but remember the market can always snap back as well. Now, to continue the story of what we've taught about today, we had mentioned earlier that you can go to RadioActiveTrading.com and access the trade simulator tool. But the other thing we want you to do is take a look at RadioActiveTrading.com, and you'll see a link there. Just put in your name and email address and get the sketch. The sketch is the free white paper that Kurt put together, which describes a little bit more about the married put position and one or two of the income methods that we use to reduce that risk and potentially get to bulletproof status. And at any time, on RadioActiveTrading.com, you'll see a tab at the top for free webinars. Simply click that, and then you'll be able to see our most recent archive presentation. Kurt actually hosted one this morning, which we should be able to have archived probably within the next hour or so, and that'll be available there for you. So you can take a look at these free resources to continue what we taught today about properly limiting risk so you can face the market with no fear, regardless if the market drops, if the market rises, or if the market stagnates, and then we'll show you how you can continue your story there to see the ways that we adjust these positions to cancel that risk to eventually get you to bulletproof status on your long stock positions. Okay? I just wanted to remind everyone, if you have any questions at any time, please feel free to send us an email to support@radioactivetrading.com. You can also give us a call during market hours. We have a toll-free number. It's 877-992-7971. That's toll-free inside the continental U.S. And if you live outside the continental U.S., you can reach us at our international number at 302-992-7971. And also when you're on the Radioactive Trading page, RadioActiveTrading.com, you'll also see a link for our next upcoming webinar that you can register again. T asks, where can the sketch be found again? Oops, sorry folks. The sketch, just go to RadioActiveTrading.com. Actually here, let me just do something real quick. Apologize folks. There we go. Sorry about that. That's what I wanted. My apologies. Hold on one second, T. There we go. Let me change my screen real quick, and we'll just go to RadioActiveTrading.com. Here at RadioActiveTrading.com, the resources tab, you see that there, right next to that is the free webinars tab. To get the sketch, just go to RadioActiveTrading.com, put in your first name, last name, and email address, and then just click Get the Sketch. We'll send you that free white paper which continues the story, shows you one or two of the income methods that are available, and you'll be able to access that as well. All right, so Reed, I think we're just about got a few minutes left. I'd like to entertain any questions that have come in. If anyone has any questions, please feel free to send those in at this time. I'm just looking through here, okay. And let me just go back to that other screen there. All right, there we go. Okay, just go back to the slide screen there, and I'll show the numbers back up again as well. So again, if you have any other questions later on, just please go ahead and send us an email to support@radioactivetrading.com, or you can also feel free to call us during market hours. The toll-free number is 877-992-7971, or of course you can reach us at 302-992-7971. That's the international number as well. Okay. Oh, okay, there's a question from John. Can I hold on to dividend stocks using your methods? Absolutely. Last year, one of my most profitable positions with the radioactive trading techniques, by the way, for the past 6 years, since I got introduced to Kurt and radioactive trading techniques, I've been implementing these techniques with about 50 to 60% of my allocated capital in my account. The reason why I'm doing that is because it's outperformed the other strategies I attempted in the 5 to 6 years previous to that in my other trades. Regardless, it was about November, I believe, of 2012. I purchased shares of Johnson & Johnson and bought a 1.5-year out put option. I went to the January 2013 leap. On that, I'm sorry, it was 2011. I bought the January 2013 leap put option, had a risk of only 5.5%. By April, actually March. By March, I had that position bulletproof, and I was guaranteed a profit of about 2%. And all I could do, if I didn't do anything for the remainder of those the remaining 8 months there from April to January, I would have collected just another 3 dividend payments and gotten a better return. As it turned out, we were able to do other adjustments following the rules there in the blueprint, John, and we were really able to still collect the dividends, earn extra profits, and we got out of that position with, I think, about a 15% gain on the stock, which is well what I expected within my goals in this strategy for about 2% per month or so. Is this strategy practical also using ETFs? This is a question from Giuseppe. Yes, indeed. Kurt's had successful trades with DIA, SPY, QQQ. I've recently traded a married put position, a RadioActive trade on the inverse ETF on SH to take advantage of some of the bearish downturn in the markets as well. So the ETFs work really well. The one we talk about that in the full work also in the blueprint. There's some caveats with the ETFs. You might not see as much ability to do some of the income methods that generate a lot of premium, but believe me, they're there, and you'll still be able to manipulate that in the time value in your favor by adjusting the puts or by generating income with some of the other adjustments we use, simply just selling a call or doing some of the riskless spread trades in the context of a married put position as well. So yes, it works for ETFs, standard and non-standard ETFs as well. I have some RadioActive customers that use the 2 times and 3 times bear and bull ETFs. I personally don't use those myself, but they're available to use. But you can also use them on ETFs, standard stock securities, more volatile, less volatile. Okay, there's a question here. William asked in, I apologize, how can I know if it is bulletproof and how do I invest in it? Okay, well, you're not, unless you already own stock. If you have stock that's already up in price, we do have tools that will be able to show you put options that you could buy to bulletproof yours right now. If I bought a stock at 50, it's currently trading at 56. I may be able to buy a 60 put a few months out in time and have no risk. Bulletproof means that your total cost basis into the position is less than the strike price of the put. On that Skyworks position we showed earlier, where it stands right now, my investment, total investment into stock and everything that I've done is $53.70 per share, but I'm holding a 55 put out to December or January. I'm sorry, out to December. So at this point, I'm guaranteed to get $55 back on an investment that I only have $5,370 in. So I'm guaranteed that profit of $130. That's bulletproof when your cost basis is below the strike price of your put. RTS, are you suggesting buying one option contract for each 100 shares? Yes, I am. Yeah, that's how we enter those positions. We talk about proper position sizing based on the risk that you're taking and the risk to your portfolio in the blueprint as well, and our educational materials. And depending on what your account size is and what you're looking to do, yes, if I open a position, I buy 100 shares, I'm going to buy one put. If I can afford the risk in my portfolio and I'm buying 300 shares, I'll buy 3 put options to a 1-to-1 ratio. I'm sorry, just last question. How about when the stock goes up? That's what we want. It's a bullish strategy. So when the stock goes up, we make the most amount of money. But when it falls, we have other ways to adjust that position as well. You'll always gain more on the stock than you're going to see a decline in the put.